Hey everyone, this is Mike DeBliss. This podcast is on collection issue updates as they pertain to the IRS. As some of you are aware, the IRS recently updated several matters that impact taxpayers in collections. This podcast will update you on the newly available information. I should let you know in advance that I'm only going to touch on certain areas, but there are more than just a few areas that these updates covered. So to the extent that you have any questions about any of the areas that I don't discuss in this podcast, feel free to shoot me an email and I'll be happy to respond. The areas discussed in this podcast are the financial standards, the updated offer and compromise booklet, and the impact of the new law on the time to file wrongful levy claims. So let's begin with financial standards. Back on March 26, 2018, the IRS issued new financial standards to be used in collection cases. These new standards basically give taxpayers guidance when it comes to preparing a collection information statement. Now, for those of you who are new or unfamiliar with a collection information statement, what it is a form that requires the taxpayer to disclose proprietary financial information about them. It goes well beyond just a run-of-the-mill checking account or retirement accounts that the taxpayer may have. It asks for information relating to the taxpayer's ownership interest in personal property and real estate, ownership interest in businesses, corporations. It's information that really gets to the nitty-gritty and oftentimes requires taxpayers a couple of weeks, if not longer, in order to do due diligence to assemble all of the information that's required to be placed on the collection information statement. And why is the collection information statement relevant? Well, if the taxpayer decides to apply for an offer in compromise, an installment agreement, to make a currently not collectible determination, or to otherwise decide the appropriate course of action in a collection case, the precursor to filing any one of those is preparing this collection information statement. Now, I am aware that there are certain thresholds when it comes to offers in compromise and installment agreements that alleviate the need to complete the onerous collection information statement and otherwise allow the taxpayer to circumvent it. There's more of a streamlined approach to expediting certain offers in compromise and installment agreements when the threshold amount is below a certain level. And so it's important to recognize that. However, when the taxpayer's tax debt substantially exceeds the threshold, there's no way to get around having to complete the collection information statement, and that's when it would be necessary to sit down and go through the labor-intensive process of filling the form out and providing all supplemental information that the IRS requires. Now, the financial standards have their roots in information published by the Bureau of Labor Statistics, and so these are not just arbitrary financial standards. There is some rhyme or reason behind it. Back on March 25, 2018, the IRS issued a new offer and compromise booklet. The updated booklet contains the following changes. The most significant change is on Form 656, Section 6, filing requirements. And there is a specific clause in Section 6 that states, quote, I, referring to the taxpayer, have filed all required tax returns and have included a complete copy of any tax return filed within 60 days prior to this offer submission, end quote. So again, this is a new clause that's been added to Section 6 on Form 656, and it's very practical in effect. But to understand why it was added and why the last part of that sentence is so significant, I have included a complete copy of any tax return filed within 60 days prior to this offer submission. It's important to have some background information. So here's the background information that will help to add some context to this change and basically explain why it was done, and it'll make perfect sense afterwards. The IRS will not work an offer if a taxpayer has not complied with the tax laws. Compliance with the tax laws means that the taxpayer is up to date in filing all of the necessary tax returns. Taxpayers who filed offers in compromise realized that it was an exercise in futility to file an offer in compromise unless they had filed all of their tax returns and they were up to date and current with their most tax return. So in some cases there were taxpayers who were not in compliance with the tax laws, meaning they were delinquent in filing a prior year or prior year's tax returns, yet they wanted to apply for an offer in compromise. So logically, what these taxpayers would do is they would, on the eve of filing their offer in compromise, they would submit a late tax return under the assumption that they are now in compliance with the tax laws because they've filed their most recent tax returns that were previously delinquent. And these taxpayers felt, rightfully so, that they had cured any defect that would otherwise prevent them from applying for an offer in compromise. Now, here was the problem with that strategy. Unbeknownst to the taxpayer, the IRS doesn't always process past due returns with the same urgency as it does currently due returns. The IRS places the most emphasis on processing currently due returns. So taxpayers who were filing returns that were several years delinquent risked having their offers in compromise rejected because the revenue officer reviewing the offer in compromise still had a message in their computer system and in the transcripts indicating that the taxpayer was delinquent in filing prior year's returns. So I realize that that's an absolute mouthful, but again, this goes to the specific case of taxpayers who recognize that they have to get into compliance by filing prior year's returns that are delinquent. And they go back in time and they file the prior year's returns in order for their offer in compromise to be processed. The problem, however, is that the IRS places the most urgency on the currently due returns. And to that extent, prior year's returns basically get pushed to the back of the line. And so a revenue officer who's reviewing the offer in compromise might as they are looking in the transcripts, notice that the taxpayer is still delinquent in filing a prior year's return, even though the taxpayer in fact submitted that prior year return on the eve of submitting the offer in compromise. As a result, what would happen is that the offer in compromise would be rejected because the taxpayer had not met the threshold condition of being in compliance with the tax laws. The new requirement, now we get to the new requirement, is that the taxpayer must attach returns filed within 60 days of the submission of the offer. And this new requirement allows the IRS offer group to avoid rejecting cases for lack of filing compliance and to get a view of the liabilities the taxpayer owes in advance of the actual assessment. The warning about waiting for the resolution of outstanding audits or claims should be considered in the context that an offer in compromise acts as a closing agreement, resolving all matters concerning the years covered by the offer. So that's very important. It's a very important distinction to note that the warning about waiting for the resolution of outstanding audits or claims has to be considered in the context that the offer basically acts as a closing agreement, resolving all matters that are covered by the offer in compromise. The taxpayer can't go back and seek a refund after obtaining an offer, and the IRS certainly can't go back and seek an additional assessment. It's important to resolve issues for the years covered by the offer, but unfortunately many taxpayers don't appreciate the scope of the offer with respect to the years it covers. Now, for low-income taxpayers, they continue to receive a benefit when applying for an offer because they are the fee is waived for the offer, and they don't have to remit a percentage of the offer at the outset. Most CPAs and tax professionals know this, but many individuals filing offers pro se may not know this and may not appreciate the benefit. So the new booklet goes out of its way to make this clearer. Wrongful levy claims. Some of you may be familiar with Revenue Code Section 6343B. Revenue Code 6343B previously required taxpayers to make a wrongful levy claim within 9 months of the taking of the property. For some people, this time frame was woefully short because they didn't even learn about the taking during that 9-month time frame. So in an effort to correct that, Congress increased the amount of time taxpayers have to seek the return of property when they believe the IRS has wrongfully taken their property while trying to collect from them. So that's basically what Congress attempted to do to cure this 9-month time frame, and the fact that there were a number of complaints alleging that it was woefully too short. It was corrected in Public Law 115-97, and that is the Tax Cuts and Jobs Act. The way it was cured is that the Tax Cuts and Jobs Act extends the period for making an administrative claim to 2 years from the previous 9 months. And if the taxpayer makes an administrative claim during that period, the time to bring suit is extended for 12 months from the date of filing of the claim, or for 6 months from the disallowance of the claim, whichever is shorter. So it's like an A or a B here. The first remedy that the Tax Cuts and Jobs Act extended is the period for making an administrative claim from 9 months to 2 years. And to the extent that the taxpayer makes an administrative claim during that period, the time to bring suit is extended for 12 months from A, the date of filing of the claim, or B, for 6 months from the disallowance of the claim, whichever time period is shorter. This change basically applies to levies made after December 22nd, 2017, and to levies made prior to that date if the 9-month period under the prior law had not yet expired. If you have any questions about the topics covered in this update on collection issues, feel free to shoot me an email, and I'd be more than happy to answer them for you. Hope this was helpful.